So you wake up one morning, check your bank balance, and realize that while you've been working hard, your money has just been sitting there, doing nothing. Meanwhile, you keep hearing stories about people who started investing a few years ago and now have a nice little nest egg. Maybe you've thought, investing sounds complicated. Isn't that just for rich people or finance nerds? Well, today I'm going to show you that it's not. In fact, investing is for everyone, even if you're just starting with a small amount. Stick with me, and by the end of this video, you'll know exactly how to take your first steps into the world of investing. Let's break this down into 5 simple sections: goal setting, picking the right account, understanding investment products, managing risk, and the basics of diversification. And don't worry, I'll share some personal stories and tips along the way, so this doesn't feel like a boring finance lecture. Before you think about stocks or funds, ask yourself, why am I investing? Is it for a house deposit in 10 years? Retirement? Maybe you just want your money to beat inflation and grow over time. When I first started, my goal was quite simple. I wanted my money to grow and not erode in value due to inflation. That time frame helped me decide how much risk I was willing to take and what kind of investments made sense for me. Think about your own goals. Are they short term, like a holiday next year, or long term, like early retirement? Generally, if you need the money within 5 years, you might be better off saving rather than investing, because investing always carries some risk. But for anything longer, investing can help your money grow faster than just sitting in a savings account. Once you've got your goal, it's time to pick the right type of investment account. This is basically the container that holds your investments. For most beginners, a standard brokerage account is the easiest place to start. You can open one online in minutes, and it lets you buy and sell a wide range of investments, like stocks, bonds, ETFs, and more. If you're thinking about retirement, you might want to look into tax-advantaged accounts, like an ISA in the UK or an IRA in the US. These accounts can give you some nice tax breaks, but they also have rules about when you can take your money out. If you are just starting out, a simple brokerage account might be ideal for the flexibility, and as your goals change, you can always add in other accounts, like a retirement account for example. And just a quick tip, before you do open any account, make sure to ask yourself, how soon might I need this money, and do I want any tax benefits? Let me know in the comments if you want a deeper dive into different account types. Now for the fun part, picking what to invest in. There are loads of options, but for beginners, I always recommend starting with broad, low-cost funds, specifically ETFs, exchange-traded funds, and index funds. These are like big baskets that hold lots of different stocks or bonds, so you don't have to pick individual companies. ETFs trade on stock exchanges just like regular shares, which mean you can buy or sell them anytime the market's open. Index funds, on the other hand, are priced just once a day, but both are designed to track the performance of a whole market, like the S&P 500 or the FTSE 100. The best part, they're cheap. You pay way less in fees compared to fancy managed funds, and you get instant diversification, which helps spread out your risk. I remember the first time I bought an ETF. It felt a bit intimidating, but once I realized I was actually buying a tiny piece of hundreds of companies at once, it all clicked. If you're not sure where to start, look for a global stock market ETF or an index fund that tracks your home country's main market. Let's talk about risk, because this is where most people get nervous. Here's the truth. Every investment comes with some risk. Prices go up and down. And yes, you might see your balance drop sometimes, but risk isn't always a bad thing. It's what gives your money the chance to grow. The key is to match your risk level to your goal and your comfort zone. If you're young and investing for the long term, you can usually afford to take more risk because you have time to ride out the bumps. If you're close to needing the money, you'll want to play it safer, maybe by adding more bonds or cash to your portfolio. When I started, I checked my account way too often and freaked out whenever it dropped by even a little. Over time though, I learned to zoom out and focus on the long-term trend. Remember, the market will have ups and downs, but if you stick to your plan, you're much more likely to succeed. Last but not least, let's talk about diversification. You've probably heard the phrase, don't put all your eggs in one basket. That's exactly what diversification is about, spreading your money across different types of investments, so you're not relying on just one thing to do well. This can mean mixing stocks and bonds, investing in different industries, or even adding a bit of property or commodities. For example, if tech stocks have a bad year, maybe healthcare or energy stocks will do better. Or if your home country's market is struggling, international investments might pick up the slack. A simple way to diversify as a beginner is to stick with broad ETFs or index funds. They do most of the hard work for you. As you get more comfortable, you can add more variety, but don't overthink it. Sometimes the simplest portfolios are the most effective. So to recap, start by setting a clear goal. Choose the right account. Pick simple, low-cost investments like ETFs or index funds. Understand your risk and make sure you're diversified. Investing isn't about getting rich overnight. It's about building wealth slowly and steadily over time. If you've made it this far, try this today. Write down your investment goal and research one ETF or index fund that fits your plan. And if you found this helpful, share it with a friend who needs a nudge to start investing. Drop your questions or stories in the comments. Remember, the best time to start investing was yesterday. The second best time is today. Thanks for watching, and I'll see you in the next one.